Well, hello everyone, David Blackborrow from Buell Capital. I'm again joined by Christian Ryan, Managing Director, to talk about what's been going on over the last few months. Now, since our last video instalment, we've just gone through reporting season, which kicked off in August and concluded in September. And reporting season is often good to just get a litmus test to see how things are going, not just at the specific company level, but also more of the global macro. So Christian, over to you. There's usually winners and losers out of the reporting season. So I guess some commentary around that, but also how does that influence our portfolio construction for the year ahead?
Yeah, thanks, David. Look, the main key themes out of reporting season this year was one, it's clear that global growth here in Australia and around the world is slowing, and two, many companies missed, I suppose, earnings guidance. Now, that can be taken in a number of ways, but it was a clear sign that companies' earnings profile are slowing. They are still positive, but they are slowing probably at a greater speed than what people expected. So the last couple of months in particular, we've seen around the world a dropping of interest rates, and obviously in Australia recently cutting rates again, and we expect interest rates to remain low and even maybe go lower again at some time. So there's a lot of discussion at the moment around how do you position for that. We're in an unknown world around how low interest rates are, but from our perspective, with all that in mind, our view is that one, interest rates will remain lower for longer, and two, that will mean, well, we think that equity share prices and growth assets will probably remain elevated for some time. The second probably main issue that we're focusing on out of reporting season is whether inflation is really sort of getting ahead of itself, and it clearly is not. It's actually going backwards. So inflation for us is probably the next big item that we follow closely to really see, if inflation is really jumping up quite hard, that will put a dramatic effect on share prices because the cost of things have got more expensive, and earnings will likely fall. But for us, although there was a lot of earnings that met, there are pockets, from our perspective that are like any time that are probably still trucking along all right. So from a portfolio positioning point of view, we did do a strategic review through August and September and started to advise clients to move into different areas. And one area that we have not been part of for quite some time and feel now is the right time to be getting back into is property, in particular residential property. So as part of portfolios, we are talking to clients and adding Stocklands as part of their portfolio. It has a massive residential land banking holding. Even if property prices don't really increase that much, the turnover of capital and properties is increasing. We've already seen clearance rates, activity, lower interest rates, things are certainly improving. So we believe that particular investment, it's at the bottom end of the cycle, and it's really a strategic call we've made in the portfolio to add back in certainly more property if you're low on property exposure. The other area that we've added into the portfolio is actually healthcare and technology. The big thing about this environment, no matter whatever the global political situation is or whether what's happening with most businesses, the two structural growth areas I think around the world that I suppose fundamentally believe will keep growing at a pretty good rate are technology type businesses and healthcare. So one of the areas that we've added more, and also more globally. So technology type investments like Visa, Microsoft, Apple, Amazon, Alibaba, globally, and here in Australia we've got stocks like Afterpay, even Seek, REA. Technology type of businesses, depending on how much risk you want to take, have certainly been added. We're certainly recommending to add to the portfolio. So across the portfolio, probably the last one structurally as well on that technology theme is we love data centers. And data centers for us is probably a new initiative we've looked at and will like to recommend to clients about. It's sort of a part technology and part property play. Data is doubling, I think every 12 months, and it's got to live somewhere. So the only main provider of data centre, or the most Australian owned or the largest Australian business, is actually NextDC. So it's, data centers is a really good, even conservative type of property stock, technology type of stock in part of the portfolio. Last time we also spoke about private credit. Fixed interest rates are falling quite dramatically, and we've actually seen bond prices, getting highly volatile over this period. Yeah. So we've stayed clear. We're staying clear of, bond type of investments. Where we are really comfortable with in Australia is private credit. Private credit is yielding really good 4, 5, 6, 7%. Yes, you've got to be careful, but private credit are sort of underpinning a good part of our fixed interest portfolio. We may miss out on a little bit of capital return by not holding much bonds, but our preference, our strategy for clients in portfolios to ensure that the cash flow remains as high as we can for the risk that we take, and the capital side of things remains pretty stable. So the key themes for us out of reporting season and looking at private credit is that our companies are in pretty healthy positions. Therefore, owning private credit or having some fixed interest in your portfolio to these types of companies that are paying high rates of interest is, we feel pretty comfortable. So the key things for us out of the reporting season is we've been increasing property. We really like that, actually over infrastructure. 2, we've added in more healthcare and technology type of investments, particularly overseas. And the third one is probably still around fixed interest. We are low in fixed interest, but if you're going to be in fixed interest, private credit is probably the area that we've enjoyed probably the best at the moment.
Okay. So between now and end of the year, there's a few months left. What are basically you looking at? Are there anything else that you're being mindful of between now and December?
Look, we're always mindful of the political situation around the world, but the actual fact is you can't, as an investor, you can't do much about it. So Brexit, I reckon Brexit's, it's an issue. Will it be resolved? I don't know. The China trade, US thing, I think it'll go on for a long time. So look, we're watching it, but we're not really, positioning for it. What the main 2 things we're focusing always is on interest rates and inflation. And so heading into December, look, October we can see some really sort of rocky period coming in at the moment. If part of our portfolio, we'd probably position it as part defensive and part still growth orientated. And it looks like hopefully over the next couple of months that, I think we benefited all right out of that through the month of September. The month of October so far looks like, I think we've buffered it a fair bit for most clients' portfolios. If you're holding, we're starting to add these into the portfolio. So I think having a bit of both is probably not a bad thing. And that's the thing, if we can see that play out all right into Christmas, then hopefully we walk away in 2019 and had a reasonable year.
That's good. All right, well, thanks for your time, Christian. Good conclusions, and thanks for watching, and we look forward to talking to you in about a month's time in the next video installment. Thank you.
Thanks, David.